Wealth Advisors, and he joins us now. Brian, thanks so much for joining us. I mean, it's going to be really hard to top 2024, isn't it? What does your outlook tell you about next year?
Yeah, thanks, Amber. Great to be with you. I think, again, a lot of this comes back to earnings outlooks, and we are constructive on both the equities and the bond market for 2025. I don't think we're not expecting the same level of equity returns that you commented on for that we've achieved so far in 24 and 25. But I think at the end of the day, we're seeing in the outlooks that contributions are coming from areas outside of mega cap tech, and talking about an environment where cyclicals can get some additional growth because demand is still there. The economy looks stable. We're not expecting movement into a recession. We have the Fed reducing interest rates, which helps to reduce the cost of doing business, both on the small and medium side, but also helps some of those cyclical areas of the economy. And assuming earnings is there, because at the end of the day, that's the foundation for valuations in the market, and seeing a little bit of a broadening in those earning outlooks coming from areas outside of tech, I think that's why we're painting a rosy picture for 25. And on the flip side, with fixed income slowing, growth in the economy, I think right now, coming off of rate cuts is why we see rates going up a little bit this year. But as time goes on, with inflation coming down and inflation and Fed cuts taking hold over the balance of next year, I think it's an opportunity for fixed income to also bounce back after, some very difficult last 3 years in the marketplace.
Why do you think rates are going to go up this year?
Well, right now, I think if you look back at history from an academic perspective, Amber, when rate cutting cycles start from the Fed, you start to see a normalization in the yield curve and rates starting to tick up in the short term. And I think right now the bond market is telling us, with rates going up, it's because the economic numbers from GDP are coming in a little stronger than expectation for the U.S. But as time goes on, we're expecting another 25 basis point cuts, or 0.25% cuts in November and December. We believe in the summary of economic projections that the Fed put out for a full 1% cut next year. And we think as time goes on, as slower economic growth continues to play out due to slower consumer spending in the U.S., we expect rates to come down over the balance of 25. And as you know, with rates going down, bond prices have a chance to rise.
So let's talk about that. You're talking about lower interest rates being delivered in the form of Fed rate cuts, but you might actually see a bit of a sell-off in the bond market, those yields rising. My question is what that could potentially mean for some of these rate-sensitive stocks that have been rallying because of lower rates. I'm thinking utilities, real estate. Is that rally vulnerable if we see a little bit of a move higher in these yields?
That's a great question, Amber. It really comes back to, I think, the strength of the job market as an indicator of the overall health of the U.S. economy. I think some of these sectors that are interest rate sensitive are also dependent as well on consumer demand. And if we see any wobbling in the labor market, that could affect the demand that might help, like, for instance, housing, a cyclical sector next year. But again, not trying to get too wonky here on the timing, rates are ticking up slightly here right now in 2024, but I still think over the balance of the next 15 months, rates will be lower. That should help some of those cyclical sectors, such as real estate, industrials, areas that are capital intensive, such as in the infrastructure space. Plus, also keep in mind, with some of the stimulus that we're hearing about from China, that might also help to move some of these cyclical areas forward next year as well, especially in the commodity space. So I think at the end of the day, we're going to get a jobs report on Friday, which will probably be the last clean report that we're going to get before the Fed meets in November, keeping in mind Boeing strikes, port strikes, and other impacts due to recent hurricane here domestically here in the U.S. So I think that jobs report and that outlook on jobs is really going to help to solidify whether or not the cyclical part of the economy, in light of declining rate cuts, is going to stay positive over the course of next year.
Ryan, you don't ever have to worry about being too wonky for us. We love it here at BNN Bloomberg. You mentioned small caps, and I think that's really interesting because there's a debate on, which side of rate cuts will small caps benefit from? Are they going to be appreciative of lower interest rates, or are they going to be disproportionately hit because the interest rates are coming down due to a slowing economy?
Yeah, no, it's a really great point because there's so many conflicting variables. But I guess I'm going to answer it this way. What we've seen so far year to date is that there's been more bankruptcies in the small to medium business areas than we've seen going back to the '08 financial crisis. And we believe the Fed is definitely aware of that, which is why they moved with a little bit of a heavier hand with a 50 basis point or 0.5% cut in September. And I think as these cuts play out, that's just lowering the cost of doing business for a small to medium business owner. Keep in mind that only 18% of companies employ more than 500 people domestically here in the United States. So as a consequence, these rate cuts are really going to make a big difference, I think, for business owners moving forward as they're trying to manage profitability and saying, look, to maintain those profits, do I have the flexibility to maintain our labor force? And that I think the Fed is very keen on and we're very sensitive to as well. But when I look at the earnings outlooks that are coming from small cap stocks or smaller companies that are out there, those outlooks still are in the double digits over the next 12 months. And if you want to, get a little bit political here with a hedge, depending on where foreign trade or foreign policy goes, having companies that are more domestically focused is one way to offset that risk. So we're in the camp, and looking back at history a little bit here as well, that as rate cuts play out, you look out over the next 12 months and small cap stocks on average over time have consistently rallied. So we're looking at that as a valuation opportunity when thinking about where large cap stocks are right now and the dominance of those valuations relative to tech versus everything else. And I think small caps is worth that risk and reward trade-off for portfolios over the next 12 to 15 months.
Brian, thanks so much for joining us with this insight. I appreciate it. That's Brian Vendig joining us.